Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. Well, let's take a look at what happened overnight. We saw a deeply negative session on global markets after Israel attacked Iran's major gas field, while Iran retaliated, striking Qatar's major LNG facility, sending oil and gas prices soaring. Adding to investor worries on Wall Street was the Federal Reserve decision, which saw rates remain on hold but project higher inflation and just one more interest rate cut this year. Reinforcing that view was higher than expected US producer price index, which rose 3.4% year on year. So among the biggest movers, Carvana and Trade Desk as well as AbbVie. Tech stocks also came under selling pressure. AMD has agreed with Samsung to expand their strategic partnership on memory chip supplies for AI infrastructure. Nvidia dipped after securing Beijing's approval to sell its second most powerful AI chips in China. SanDisk gained while after the bell, Micron Technology forecast third quarter revenue well above Wall Street expectations after posting a sharp jump in the second quarter on booming demand for memory chips used in AI systems. Asset managers Apollo Global and RS Management rebounded after sharp losses in the previous week on private credit quality concerns. Lululemon surged after the yoga wear maker's quarterly results, and Macy's jumped after the department store chain said it expected a comparatively smaller impact from tariffs in the second half and beat quarterly profit estimates. Well, the Federal Reserve has held interest rates steady and projected steady unemployment. However,
the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy.
Well, new projections from the central bank's policymakers showed the Fed's benchmark overnight interest rate would fall by just 0.25 percentage point by the end of this year, with no indication about the timing of such a move, given the uncertainty around the Middle East conflict and its inflationary effects.
We haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Meanwhile, oil prices have surged again after Iran's Pars gas field was hit in a major escalation in the US-Israeli war. And Qatar's state oil giant Qatar LNG reported extensive damage after its energy hub at Ras Laffan was hit by Iranian missiles. Here at home, Treasury has forecast that if the war is prolonged and oil rises to $120 by the middle of the year, inflation would reach at least 5%. And the impact on economic growth would be severe. Well, US Treasury yields rose after the Fed maintained its forecast for a single rate reduction this year, the two-year yield jumping 9 basis points to 3.76%, the 10-year up to 4.26%. The Australian three-year government bond yields rose to 4.6%, the 10-year was up to 4.98%. US dollar index up around 0.5% on the day, the Aussie sinking more than 1%, currently at 70.3 US cents. Oil prices have surged after Iran attacked Qatar's energy hub and threatened several energy facilities across the Middle East in retaliation for a strike on its major gas field. Brent crude futures up 7.5% to close to $111 US a barrel. Gold has tumbled almost 4% to around $4,815 an ounce on a strong US dollar and the prospect of higher inflation. And copper fell 3%, iron ore 1% lower at 110 US a ton, and Bitcoin is currently at around $71,000. Well, let's get across all those market moves. Ira Epstein joining us from Linn and Associates. Ira, welcome back. Now, we'll get to the Fed in just a moment. Let's look at that existential crisis that's playing out in terms of energy, given we've had a strike on Iran's facilities, retaliatory strikes across the Middle East, and as a result, we have seen both oil and gas prices rise considerably.
Yeah, that is it. And thanks for having me, by the way. And what a day to be on, because there's so much going on here. I think everybody has to sit back and consider what would be the case right now, I don't care what country in the world, if Iran had that nuclear weapon. You are seeing how cutthroat they are. These neighbors of theirs have done nothing to them. And yet there they are attacking them left and right. This is all Iran's making from my perspective. I don't speak for America, but I speak for what I believe in. And I can only imagine that they'd be sitting there with a missile, ICBM, ready with a warhead, threatening country upon country, do it their way or take the highway, because that is what the world would be. So we have to sit there right now and take this. Qatar LNG represents 20% of the world production. It's going to be offline conservatively through late summer, from what I'm reading right now. We have their company that said that, and then Shell is there as well. So we'll see what that means. What the U.S. is going to be forced into doing somewhere along the line is probably cutting off in some manner to get Iran down to the economic knees what Kharg Island does. They can do it by turning off the electricity to the island. I know it sounds crazy, but that's it. The repercussion, of course, is you lose the oil. But I must tell you, other than China, who's getting their oil? India was getting a little bit, but India can now buy Russian oil. So I think that's what you're going to be looking at from all I'm hearing. And what this means is higher energy prices. I listened to the analysts coming out that they've made a top, that top of 120 is it. It would normally be, if you didn't have a war situation, that you can't judge. And everything is getting quickly out of control. The genie's out of the bottle. And now the question is each day, how serious does it get and what do you have to do? So you look at what Fed Chair Powell said today. There's no way to measure at this point in time what this all means or how long this high oil price goes. If the regime went down there, well, then Kharg Island would reopen. I think we all agree that we don't want to see infrastructure damage to that. But for the mainland, that's a whole different ball game. You can go after different things, and Israel's doing it, whether the U.S. likes it or not. And they are systematically taking out all the top people in Iran. No one is safe there anywhere, including underground. So that's where you're at with that part. As for what it does here, you get interest rates to go higher. You take the stock market down. And folks, I'm going to tell you, at the end of the day, there will be companies that aren't affected by this, and those are the things you look at, and that's where you go. I can tell you what I've got my clients in, and they are short the yen and short notes. Those are the two trades in the futures markets. We went into the Fed meeting, we carried that through the weekend, and that's basically where you're at. Not in the metal markets. I told you last time, metals weren't responding to inflation or war. When you see that, you run from them. You don't run to them. People are saying it's the dollar. The dollar's not that dramatically higher. It's been here before. It's pushing the 100 level. So you've got to have a game plan, and you have to stick to it.
Ira, the equity market has been remarkably resilient. Are you expecting that to crack?
It has cracked, but it's not going to crash. Underneath it, the U.S. stock economy. I should say the U.S. economy, not the stock economy. The U.S. economy is strong as can be. You heard the Fed chair say it. And as you look at each report that comes out, that's where you're at. Now, the problem for the economy, and Andrew, you're onto something big, is $4 gasoline in America. I'm not talking the premium. I'm talking regular blend. And at $4, we did get into trouble the last time that was hit. So we have to see, number one, if it goes there, is it systematic? In other words, is it going to stay there, or is it a flash in the pan that it goes up? And I can't answer that question for you. I can tell you I don't want to be the guy picking a bottom. I don't want to be the guy, as the president of the United States says, when they finish what they have to do, the energy prices will fall. Well, when is that? Is that this week? Is it 3 weeks from now? Is it 6 weeks? Because it's a moving target. There's no way to know that. So what you have to do in markets like this is not be so much of a position holder for the very, very long term, but you pick your spots. Example, in the yen, they 100% import their energy needs. I can't think of a better country to be short for that reason. Doesn't mean I'll end up being right. Right now I happen to be. As for bonds and notes, well, how are you going to break interest rates in this country right now? You're not. So they're going to go up because you have inflation. And the Fed's in a rock and a hard place. They can't cut rates if you have inflation going up because of energy. All you're going to do then is feed the inflation.
Well, indeed.
This is a very difficult situation.
And it is a dilemma faced by all central banks across the globe at the moment. Ira, given the inflationary effects of energy prices and the drag that has on economic growth, how real are the prospects of stagflation, do you think?
Oh, no. How's that, just for an honest answer? There are so many I don't knows right now. As I said, I think you just sit back, you pick your shot. I gave you the reason that I liked those two trades for my customers. Last time you asked me, what do you do if you're holding a stock position? Do you ride it out? And what I had done in most of my positions, and when I say positions, recommendations for my clients through my advisory service, I had told them to cut positions down to 25 to 40%, even 10% of a normal size, and ride it. And the reason is, when it turns, you're not going to have a chance in. So this is a market where you start looking in the stock market at companies you like. Example, I like a company, Energy Transfer, that works in America with LNG, and they transport it. Well, with what just went on in Qatar, I think their prospects look better. I'm not going to tell you where to come in here. That's not what we do. But what we talk here is the generality of the market in this show. And in the generality of this market, I think you're going to have high interest rates for a bit. I think we have to get a handle on when the U.S. can end this escapade. How's that? I don't know if it's an intrusion, exclusion, as the president calls it, or a war. But it's something. And until it ends, you're going to get more of these. And the shocks are to the upside, not to the downside till this ends.
All right, very good to catch up with you and your analysis. Thanks for joining us from Linn & Associates.
Thanks, Brett.
Let's turn our attention to the local market. Now, brace yourselves. We are expecting significant selling, as you can see. SPY futures there off 1 3/4%, reflecting on what we saw on global markets overnight. Obviously, the focus very much on what is playing out in the Middle East, particularly given now energy infrastructure very much been targeted on both sides of this conflict. Stay with us, the Open just around the corner.